For 4 years, one woman sat at the very center of America's financial power. She controlled the nation's wallet, advised presidents, and shaped global markets. And now, she's sounding an alarm so severe that it makes past economic warnings look tame. In early January 2026, Janet Yellen stepped onto a stage filled with the world's top economists and compared today, assess America, to something no one ever wants to hear. The final days of the Roman Empire. Not a recession, not a slowdown. A collapse driven by debt. What she described isn't a distant threat. It is a condition that may already be taking hold, quietly reshaping your savings, your home, and your future. The problem facing the United States is no longer abstract or theoretical. It has a name, a price tag, and real consequences. Economists call it fiscal dominance, a condition where government debt grows so massive that it begins to control the entire economy. When this happens, policymakers lose their freedom to act. Interest rates, inflation, growth, and even political decisions become hostages to debt. As of January 2026, the United States owes roughly $38 trillion. That number alone is staggering. But the real danger lies in what it represents. The entire U.S. economy produces about $32 trillion worth of goods and services per year. That means America now owes more than it produces annually. Debt has reached about 120% of GDP, a level that historically signals severe stress for nations. Even worse, the cost of carrying that debt is exploding. The federal government now spends around $1 trillion every year just on interest payments. Not on schools, not on healthcare, not on defense, just interest. 6 years ago, that number was barely 1/3 as large. Within a decade, it's projected to climb even higher. This creates a vicious cycle. As interest costs rise, the government must borrow more just to pay the interest. That new borrowing increases total debt, which raises interest costs again. It's a self-reinforcing loop with no painless exit. In normal times, the Federal Reserve would step in to fight inflation by raising interest rates. But today, even modest rate hikes dramatically increase the government's interest burden, push rates too high, and the budget collapses under its own weight. So the central bank hesitates, inflation lingers, confidence erodes. This is the core problem. Debt is no longer something policymakers manage. Debt is now managing them. What makes this moment especially dangerous is how normal everything still looks. There's no panic in the streets, no emergency speeches on every channel. The stock market still opens each morning. The dollar still buys groceries. Most people wake up, go to work, and assume the system is stable, because it always has been. But history shows that the most destructive financial crises rarely arrive with loud warnings. They arrive quietly, while confidence slowly drains away. Behind the scenes, something deeply unusual is happening. The traditional rules of economic management are no longer working the way they used to. The Federal Reserve has begun cutting interest rates, yet mortgage rates remain stubbornly high. Treasury yields refuse to fall. Borrowing is still expensive for families, businesses, and students. That disconnect should not exist in a healthy system. It signals stress beneath the surface. At the same time, the people who once financed America's debt without hesitation are stepping back. Foreign governments are no longer the reliable buyers they once were. Central banks around the world are stockpiling gold at record levels. Long-term investors are demanding higher returns just to hold U.S. bonds, assets that were once considered virtually risk-free. Long-term investors are demanding higher returns just to hold U.S. bonds, assets that were once considered virtually risk-free. These shifts aren't ideological, they're mathematical. Investors are beginning to question whether America can keep borrowing at this pace without consequences. What makes this especially alarming is timing. The United States is entering this period with historically high debt, rising interest costs, and little political appetite for hard choices. In past crises, Washington could borrow aggressively to stabilize the economy. Today, that option is shrinking. The credit card is already close to maxed out, and yet spending continues. New laws add trillions more to deficits. Defense budgets expand, tax revenues fall. Each decision adds weight to an already overloaded system. Like a bridge carrying more traffic than it was designed for, the structure doesn't collapse immediately, but stress fractures spread. This is why Janet Yellen's warning matters so much. She didn't speak as an outsider or a critic. She spoke as someone who helped shape the system and understands its limits. When someone at that level invokes the fall of Rome, it's not hyperbole. It's recognition of a familiar pattern. The question is no longer whether pressure is building. It's how long the system can absorb it before something finally gives. To understand why America has reached this dangerous point, we have to look beyond headlines and trace the slow chain of decisions that built today's crisis. This didn't begin overnight, and it didn't start with a single president, party, or policy. It was the result of decades of choices that seemed harmless at the time, but together created an unsustainable system. For most of American history, government debt followed a clear logic. The country borrowed heavily during emergencies, wars, recessions, national crises, and then worked to reduce that debt during periods of growth. Debt was treated as temporary, something to be managed carefully. This belief formed the backbone of American financial credibility and allowed the United States to borrow cheaply for generations. That discipline began to erode in the modern era, but the real turning point came during the pandemic years. Faced with an unprecedented global shutdown, Washington opened the spending floodgates. Trillions of dollars were injected into the economy in record time. Lawmakers assured the public that this was necessary, that the debt could be handled later, and that inflation would remain under control. At the time, those assurances were widely believed. Interest rates were low, the dollar was strong, markets appeared calm, but beneath the surface, the scale of borrowing had fundamentally changed the structure of the U.S. economy. When inflation began rising sharply in the early 2020s, the Federal Reserve was forced to respond. Interest rates were raised at the fastest pace in decades. This move succeeded in slowing inflation, but it also exposed a hidden vulnerability. Every rate hike dramatically increased the government's interest payments on its massive debt. What had once been manageable quickly became overwhelming. In earlier eras, this would not have been a fatal problem. During the early 1980s, for example, the Federal Reserve raised interest rates to extreme levels to crush inflation. It worked because the national debt was relatively small. The government could absorb higher interest costs without destabilizing its finances. That option no longer exists. Today, debt exceeds the size of the entire economy. Even small increases in interest rates translate into hundreds of billions of dollars in additional costs. This creates an impossible dilemma. If the Federal Reserve raises rates to fight inflation, it risks triggering a fiscal crisis. If it keeps rates low to protect government finances, inflation lingers and purchasing power erodes. Either path carries serious consequences. This is the moment economists describe as fiscal dominance, the point at which government debt begins to dictate monetary policy instead of the other way around. The central bank loses its independence not through legislation, but through mathematics. Meanwhile, Congress continued to spend. Temporary tax cuts became permanent. New deductions were added. Defense and border spending expanded. The debt ceiling was raised repeatedly, each time with promises that discipline would return later. But later never came. Budget projections began to worsen. Independent analysts warned that debt levels were on track to reach heights historically associated with economic instability. The numbers grew so large that they became abstract to most people. Trillions upon trillions, hard to visualize and easy to ignore. But markets did not ignore them. Foreign governments that once eagerly bought U.S. Treasury bonds began quietly reducing their exposure. Central banks around the world increased gold purchases. Hedging against dollar risk, long-term investors demanded higher yields to compensate for growing uncertainty. These shifts happened gradually, without drama, but their impact was profound. Even when the Federal Reserve began cutting interest rates, long-term borrowing costs stayed high. Mortgage rates refused to fall. Business loans remained expensive. This breakdown in the usual transmission of monetary policy was a warning sign that confidence was weakening. At the same time, political dysfunction worsened the situation. Government shutdowns became longer and more frequent. Budget negotiations focused not on reducing deficits, but on dividing borrowed money. Each standoff sent another signal to investors that long-term fiscal stability was no longer a priority. Social programs faced looming shortfalls. Social Security's trust fund moved closer to depletion. Medicare costs climbed. Fewer workers were projected to support more retirees. These demographic realities added another layer of strain to an already stressed system. National security concerns also grew. A country spending $1 trillion a year on interest has less flexibility to invest in defense, innovation, and global leadership. Adversaries noticed, allies noticed. Financial weakness became a strategic vulnerability. As these pressures accumulated, respected economists began drawing uncomfortable historical parallels. Not because America is identical to past empires, but because the patterns were familiar. Excessive debt, currency debasement, political paralysis, gradual loss of trust. Janet Yellen's comparison to Rome was not a prediction of imminent collapse. It was a recognition of trajectory. Rome did not fall in a single year. It declined over generations as financial shortcuts replaced sustainable policy. Coins were diluted, promises multiplied, confidence eroded. America's situation is different in form, but similar in principle. The country isn't shaving metal from coins, but it is diluting the dollar through persistent deficits and inflation. It is making commitments without credible plans to fund them. And it is relying on the assumption that global confidence will last forever. That assumption is risky. Trust is the foundation of any financial system. Trust that debts will be paid. Trust that money will hold value. Trust that policymakers will act before crisis becomes unavoidable. Once that trust begins to crack, restoring it becomes extraordinarily difficult. This is where America stands today, not in collapse, but in a narrowing corridor of options. The choices available are becoming more painful, more politically costly, and more disruptive. Delay only increases the eventual price. The story of America's debt is not one of sudden failure, but of gradual constraint. A system that once offered flexibility and resilience is becoming rigid and fragile. The longer this continues, the harder it becomes to change course without shock. And that is why this moment matters. Not because disaster is guaranteed tomorrow, but because the path forward is closing faster than most people realize. Here, and what is the uncomfortable truth, there is no painless solution left. To reduce debt meaningfully, the government must either cut spending, raise taxes, or inflate the debt away. Each option carries severe consequences. Cutting spending means touching programs voters rely on: Social Security, Medicare, defense, healthcare. Raising taxes risks slowing growth and angering powerful interests. Inflation quietly reduces debt, but destroys savings and purchasing power. So politicians choose the fourth option: delay, borrow more, hope the crisis lands on someone else's watch. But markets don't wait forever. As debt grows, investors demand higher yields. Higher yields raise borrowing costs across the economy. Mortgage rates stay high. Student loan interest rises. Business investment slows. Growth weakens. At the same time, interest payments consume a growing share of tax revenue. Soon, a quarter of all income taxes could go just to interest. Not services, not infrastructure. Interest. This creates a political powder keg. Money flows upward to bondholders, often wealthy investors or foreign entities, while public services face cuts. Inequality widens. Social tension rises. Even establishment voices are shifting. Figures who once championed tax cuts now acknowledge that higher revenues may be unavoidable. When longtime advocates of low taxes change their tune, it signals desperation. Janet Yellen herself admitted that the policies she once supported helped create today's reality. Her warning wasn't abstract, it was personal. And perhaps most alarming is her conclusion: yes, we should be concerned. Not someday. Now. Now let's bring this closer to home, because this story isn't just about charts, economists, or trillion-dollar numbers. It's about you, your family, and the life you're trying to build. When government debt reaches this scale, it doesn't stay trapped in Washington. It leaks into everyday life in ways most people don't immediately connect. If you own a home, you're already feeling it. Mortgage rates stay high even when the Federal Reserve cuts rates, because long-term Treasury yields set the floor. Refinancing becomes harder. First-time buyers get locked out. Housing slows, and wealth creation stalls. If you rent, those higher financing costs eventually get passed on to you. If you have a retirement account, understand this: bonds are no longer the safe anchor they once were. When confidence in government debt weakens, portfolios that rely on stability can take sudden hits. Volatility isn't a side effect. It becomes the new normal. If you rely on Social Security, or expect to one day, the clock is ticking faster than most people realize. Trust funds running dry means cuts are no longer hypothetical. They're scheduled. And once cuts start, they rarely stop at the first reduction. Even if you think you're insulated, inflation quietly taxes everyone. It erodes savings, shrinks purchasing power, and forces households to work harder just to stay in place. That's the hidden cost of a system stretched too far. This isn't about panic, it's about awareness. Because when you understand what's happening, you can prepare instead of being blindsided. And in times like these, preparation is the difference between control and chaos. So where does this leave America right now? Not at the edge of an immediate collapse, but in a narrowing tunnel where every step forward becomes harder than the last. The system is still functioning, bills are still being paid, markets are still open. But the flexibility that once defined American economic power is fading fast. History shows that countries don't lose financial stability all at once. They lose it slowly through denial, delay, and the belief that tomorrow's growth will fix today's excesses. Each year without reform makes the eventual correction more painful. Each trillion added reduces the room to maneuver, and each political promise funded by borrowing pushes the reckoning closer. What makes this moment different is awareness. The warning signs are no longer hidden in obscure reports. They're being spoken openly by former Treasury secretaries, central bankers, and budget watchdogs. The bond market is reacting. Foreign buyers are stepping back. Long-term interest rates are sending signals that can't be ignored. The question now isn't whether change is needed. It's whether change happens by choice or by force. History suggests that governments rarely act until markets compel them to. And when that happens, the adjustment is fast, chaotic, and unforgiving. America still has time. Not unlimited time, but time. Time to prepare personally. Time to understand what's coming. Time to recognize that stability is no longer guaranteed by default. This story doesn't end here. It's unfolding in real time. The numbers will keep changing. The pressure will keep building, and the decisions made next will shape the economy for decades. The loop is simple. Debt grows, confidence weakens, costs rise, and then the cycle repeats until it doesn't. And when that break finally comes, the only question left will be who saw it coming and who didn't.